Netflix just posted the most profitable year in the history of streaming media, with nearly $11 billion in pure net income, a figure that grew 26% year over year and cemented their status as the untouchable king of entertainment. By all conventional metrics, this company is a cash printing machine that should be buying islands, not visiting loan sharks. Yet, just days after releasing these record-breaking numbers, they secretly signed what looks like a financial death warrant worth $67 billion. The answer to this contradiction is not on the front page of the Wall Street Journal or in the glossy investor presentation. It is buried deep in Note 7 and Note 14 of their latest 10-K filing, revealing that Netflix is no longer just a media company. It is mutated into a hedge fund playing the most dangerous game of leverage the market has ever seen. Hello, welcome to the Capital War Podcast, where we strip away the corporate press releases to expose the raw mechanics of wealth management and capital allocation. Today, we are conducting a forensic audit of the Netflix fiscal year 2025 financial report. This is a company that is currently pushing all its chips into the middle of the table, betting its entire existence on a transformation from a streaming service into the undisputed emperor of media. But as any veteran of the financial markets knows, in the world of high-stakes investment portfolios, there is no such thing as a risk-free return. Today, we are going to tear apart the financial structure of Netflix to show you why their balance sheet currently looks less like a technology giant and more like a leveraged buyout shop operating on the edge of a knife. First, we must acknowledge the surface-level victory because the headline numbers are undeniably impressive. In 2025, Netflix generated a staggering $45.1 billion in total revenue, growing 16% from the previous year. The real star of the show, however, was their operating margin, which hit 29.5%. For context, in the capital-intensive world of media production, a margin nearing 30% is the holy grail. It is the kind of efficiency that attracts investors looking for reliable passive income and growth. They are converting revenue into profit at a rate that legacy studios can only dream of. However, while the market celebrates these profit margins, we need to look at the massive iceberg beneath the surface. The part you see above the water is the $11 billion in profit. The part submerged below, which is vastly larger and far more dangerous, is a mountain of new debt being constructed to fund the acquisition of Warner Bros. Discovery. Before this deal, Netflix carried about $14.5 billion in long-term debt, which was manageable given their cash flow. But to close this historic merger, they have engaged in a level of financial engineering that is frankly terrifying. According to the bridge facility documents referenced in the 10-K, Netflix has secured a new debt package totaling $67.2 billion. This is not a standard mortgage. This is a complex beast comprised of three distinct tranches. First, there is the bridge loan of $42.2 billion. Think of a bridge loan like an emergency oxygen tank for a diver. It is designed to keep you alive for a very short time until you reach safety, but if you stay on it too long, you run out of air. It is short-term, expensive debt meant to close the deal quickly. Then, there is a $20 billion delayed draw term loan and a $5 billion revolving credit facility. This is effectively a leveraged buyout, or LBO, where Netflix is using its own creditworthiness as collateral to swallow a massive competitor. If this works, they control the largest content library on Earth. If it fails, this $67 billion liability becomes a liquidity trap. And this brings us to the single most critical risk factor found in the fine print, the covenant trap. Banks do not lend $67 billion on a handshake. The credit agreement contains a strict financial covenant requiring Netflix to maintain a consolidated EBITDA to interest expense ratio of at least 3.0 to 1.0. In plain English, this means that for every dollar of interest they owe on this massive pile of debt, they must generate at least $3 in earnings before interest and taxes. Right now, in 2025, their interest expense is only $776 million. That is a rounding error for them. But the moment they draw down that $67 billion to pay for Warner Bros. Discovery, their interest payments will skyrocket from millions into billions. This is where the mathematics of capital allocation get brutal. If interest rates remain higher for longer in 2026, or if a global recession hits advertising revenue, their earnings could dip while their interest payments soar. If that ratio falls below 3 to 1, the banks can technically declare a default and demand immediate repayment. This is the scenario that could wipe out equity holders overnight, and it is why portfolio rebalancing is essential when holding a stock undergoing this kind of structural leverage shift. But let us play the other side of this trade, because while the debt is terrifying, Netflix has built a defensive moat that is virtually impenetrable. In the world of wealth management, we call this a content fortress. If you look at the balance sheet for fiscal year 2025, their net content assets are valued at $32.8 billion. This includes $12.4 billion in licensed content and over $20 billion in original productions that they own outright. This is not just a library of movies, it's a war chest of intellectual property that generates passive income every second of the day. However, to understand the true quality of this business, you have to understand the difference between profit and cash flow. This is where most amateur investors get lost. In 2025, Netflix recorded an expense called amortization of $16.4 billion. Amortization is an accounting term that represents the declining value of their old movies, similar to how your car loses value the moment you drive it off the lot. It is a non-cash expense, meaning no actual money left the bank account for it this year. But here is the catch. While they wrote off $16 billion on paper, they actually spent $17.1 billion in cold hard cash to produce new content. This reveals the brutal reality of the streaming business model. It is a capital-intensive treadmill. They cannot simply sit back and collect checks like a landlord. They must burn $17 billion a year just to stay in the same place. If they stop spending, the subscribers leave and the revenue collapses. This relentless need for cash reinvestment is why capital allocation strategy is the most important metric to watch. Speaking of capital allocation, let us look at where the rest of the money went. In 2025, Netflix generated $10.1 billion in net cash from operating activities. This is a fantastic number, showing the core business is healthy. But what did management do with this cash? They did not pay down debt. They did not save it for a rainy day. Instead, they spent $9.1 billion repurchasing their own stock. Buybacks are a double-edged sword. On one hand, it reduces the number of shares outstanding, which artificially boosts earnings per share to $2.58. This makes the stock look more attractive and drives up the price, which is great for executives with stock options. But on the other hand, when you're about to take on $67 billion in new debt for a merger, spending $9 billion to buy back your own stock is an aggressive, high-confidence bet. It signals that management believes their stock is undervalued, or perhaps they're trying to prop up the price before the dilution from the merger hits. For those of you focused on financial freedom and long-term portfolio stability, this aggressive spending in the face of rising debt is a signal to watch very closely. Finally, we must address the structural risk that no one talks about: cloud infrastructure. Netflix does not own its own data centers. They run their entire empire on Amazon Web Services, or AWS. In their risk factors, they explicitly state that they cannot easily switch to another cloud provider. This creates a bizarre dynamic where Netflix pays billions of dollars to Amazon, a company that is simultaneously trying to kill them with Amazon Prime Video. It's like renting a storefront from your biggest competitor. If Amazon decides to squeeze them on pricing or prioritize their own traffic, Netflix is vulnerable. This is a structural dependency that adds a layer of invisible risk to the stock. So what is the final verdict for the intelligent investor in 2026? Netflix is no longer just a growth story. It has evolved into a complex financial instrument. They are using massive leverage to acquire Warner Bros. Discovery, effectively betting the entire company that they can generate enough cash flow to service a mountain of debt while continuing to burn $17 billion a year on new shows. If the economy holds strong, this merger could create a monopoly that dominates the next decade of media. But if we hit a recession, that 3-to-1 debt covenant becomes a ticking bomb. This is not a stock for the faint of heart. It is a high-stakes play on the future of media consolidation. If you're holding this in your portfolio, you need to be watching their quarterly interest coverage ratio like a hawk. Do not just read the headlines, read the footnotes.